Hello, tax season is just about over. April 15th is right around the corner, and if you haven't filed by then, you'll definitely want to file an extension to avoid penalties. But these videos are going to be to help you tackle the basic understanding of why taxes exist, how you can actually estimate and calculate your own taxes, and just get a good feel for how your different financial decisions that you're making may impact your uh, ultimately your taxes due or your tax refund. As always, I have to include these disclosures just for compliance purposes. I'll give you a second to read through those. But now we'll dive right in and kind of see, I'm breaking it out into two parts. So part one is going to be why taxes exist and how to calculate it. So the how to calculate it is going to be helpful. But then part two, I'm breaking it into two just so it's more easily digestible for you. We'll be talking about deductions versus credits because they're very different as far as how that impacts your taxes. Talk about the impact of retirement accounts and how those impact your taxes as well. Then we'll actually go through a detailed example of how to calculate taxes using real numbers in a real situation. Then lastly, we'll talk about the tax reform and how that may impact you moving forward. So Benjamin Franklin said, "In this world, nothing can be said to be certain except for death and taxes." And so it's a very famous quote, and it's pretty accurate. It's very hard to avoid paying taxes. I know I get messages all the time, how can I legally avoid taxes? And there's not too many options out there, not any legal ones at least. So why do taxes exist? So primarily, taxes, you're essentially paying into the government, and it's because they have expenses that they need to fund. These are the most common things that kind of stand out in my mind. There's a few other ones, and then these also kind of get split out into other kind of things that borderline kind of have that same future and benefit. So infrastructure. So infrastructure for the United States as a whole, whether it be for the economy or just building buildings, roads, bridges, those types of things. Education, investing in the education system, social programs, Social Security and Medicare have their own kind of separate tax than just the normal federal taxes that you end up falling into. But still, those federal taxes you pay still fund a lot of social programs. Then national security is a big one as well that I know is popular. So how do you calculate your taxes? There's going to be a series of slides that we're going to walk through to just give you a basic understanding. And it looks pretty simple. It actually is pretty simple to estimate your taxes and calculate your taxes. It's just understanding what piece of information, when you get these tax forms, the 1099-Rs, your 1040s, and all those different numbers and sheets that you're going to receive. And those all kind of funnel into one of these main pieces that I'm going to talk about. At least I'm focusing on all the ones that would probably impact 75–80% of the people that are watching this. So obviously I don't have time to go through every piece of the tax code, but these are going to impact almost everyone that's listening. So your income, and there's different variations. It could be employment, tips, investment, retirement income. All those things fall under income, and those are important. That's really what your taxes are going to be based off of primarily. But there are adjustments that are going to be made to them, and those adjustments could look like student loan interest deductions or adjustments, and anything that you contribute to HSA or retirement accounts, those could reduce the income in the form of adjustments as well. And so once you calculate that out, that gives you a very key number, which is your adjusted gross income. The reason why that's a key number is because that's really going to identify whether you earn too much to qualify for certain credits and deductions. And so we'll carry that adjusted gross income to this next equation, and looking at that, we're going to subtract the deductions from it. So usually you have two options. There's the standard itemized deductions, and so that's standard deductions. That's what most people are going to be taking these days with the recent tax reform changes that I'll definitely dive into more specifically in the second video. Or you can itemize your deductions. So that's if you meet certain criteria, there's certain items and expenses and investments that you may make that may qualify under itemized deductions. Not as common moving forward, but either way, you decide which one of those deductions you're going to take that subtracts from the adjusted gross income, and then that gives you your taxable income number. So this still isn't the final number we need. What we need to get to is how much you actually owe. But with that taxable income, kind of broke this out. This one definitely is where it gets a little bit more complicated. So there's your taxable income, and then what you do is you actually look at your tax bracket. And so don't worry, that's a small one there, just kind of showing you that that's where the numbers get crunched. That's how you estimate what you may owe in taxes. And so you kind of apply your tax bracket to the taxable income that you have, and that's going to tell you the taxable or the taxes owed at that time. And that's still not the final calculation, though. There may be credits that applied. You most likely paid in, whether it's through your employment income or you're making quarterly payments or some other form or fashion that you were paying taxes all throughout the year. The credits and the taxes paid all get subtracted dollar for dollar from the taxes owed. And that's going to give you the idea of whether or not you're going to get a refund or whether or not you owe money come tax season and once you file your taxes. So we're looking at the 2018 tax bracket here. And in the US, we have a progressive tax system. So the lower portions of your income that you earn first get applied at lower tax rates. And as your income grows, the higher amounts end up getting taxed at those higher percentages. So if we just look in this example, looking at the married filing jointly, someone that falls in the 22% bracket, that means any additional dollars most likely are going to be applied at 22% for the taxes. But some of those previous amounts, so the first $19,000 of taxable income was going to be, they're only paying 10% on that, and only 12% after that between $19,000 and $77,000 about. So hopefully that gives you a good idea of how to estimate and calculate your taxes. The next video that I'm going to share is actually going to be more detailed. We'll actually look at the numbers, and we'll look again at these tax brackets and see where these numbers are coming from and how to estimate what those taxes could look like. So hopefully that was helpful, and stay tuned and reach out if you have any questions.